It was a quiet day with the S&P 500 basically flat. We did see a little bit more movement out of the Dow Jones Industrial Average, partially because Goldman Sachs and Travelers both reported earnings today, and the market didn't really like what they saw there. So we'll take a look at that, see what sort of an impact it has on the various postures across our indices out there. There is one index that's really been impressive over the last week that I spend a lot of time discussing in tonight's video. Also want to talk about some of the different asset classes out there. Speaking of impressive, have you seen Bitcoin lately? That thing has really been taking off in the last week or so. So we'll take a look at that, see what the results suggest for moving forward with many of those risk-on asset classes, in addition to what we learned through the interpretation of sector rotation. We'll then get into our trade application example, and tonight we're going to focus on a bearish trade on a telecom stock that seems to be rolling over at a key resistance area with a bearish near-term divergence signal. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 17th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. Remember, at the bottom of those emails, you'll also find which stocks are giving you overbought and oversold cluster signals within the S&P 500, assuming that there are any. Some days there aren't any overbought or oversold clusters, but at the bottom of those emails is where you'll find them. Also, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got my S&P 500 heat map pulled up here to kind of get the conversation started today. And as you can see, we mostly have a lot of red as we come back from this holiday shortened week that we're in the midst of right now. Those of you that are overseas perhaps had a day of trading already yesterday, but here in the United States, we observed the Martin Luther King Jr. Day yesterday, so no trading yesterday. So today is the first glimpse at what may come this week, and so far not looking so hot out there. The end result for the market really wasn't too bad. We were only down like 0.2% or something like that. But you can see here we do seem to have a lot more red squares and rectangles than green ones. However, there were some important green ones that did show up to kind of help balance the scales from a market cap perspective. Specifically, you can see Apple was up today, almost 1%. You had Microsoft that was up 0.5%. I think I heard that Microsoft was going to go through a pretty major round of layoffs here shortly, and markets have been kind of cheering that news. I know it sounds a bit peculiar, and we never want to see people losing their jobs, but that is one way where inflation can get a little bit more under control if there is not as many paychecks being paid out there. And so who knows, this is part of the painful process that may be required to get us back onto a road of recovery moving forward. And Microsoft kind of followed in the footsteps of Meta and Amazon and others that have made decisions like that here in recent weeks and months. You'll also notice that Nvidia had a very big day. It was up nearly 5% today, 4.75% to be exact. So a pretty strong performance there, and it really didn't seem to be something that was associated with its industry. In other words, a lot of the other semiconductor companies finished the day in the red today. So I didn't happen to see what the news was on Nvidia, but my guess is it must have been something pretty specific to it. Maybe they got an analyst upgrade or something along those lines. But that's nice to see because Nvidia is a very important company to this market with a $435 billion market cap these days. You'll also find that Tesla had a big day over here. Boy, it seems like most of the times I've been doing the Market Outlook video in recent months, Tesla has been down on the vast majority of those days. So today was a nice little rally back in the opposite direction. It was up 7.43% here today. So pretty nice one there for that consumer discretionary stock. You also saw that McDonald's was up 1.94% today. Disney was up about 0.5% today as they kind of fired back at Nelson Peltz and Trion investors who had been kind of rattling the cages over there at Disney last week. So buckle up. It's probably going to be an interesting relationship between those two entities as we move forward. We also saw that Chevron had a pretty nice day, up 1.65% here today. Coca-Cola was up a touch here today. Pepsi was up a touch. Costco was up a touch. We did have NextEra Energy up as well. And then the last up stock that I'll mention is Morgan Stanley. Now, Morgan Stanley actually reported earnings today. Remember, we kicked off earnings season basically on Friday. That's kind of the unofficial start of earnings season, when we had all those other more traditional banks report their earnings, stocks like JP Morgan and Wells Fargo and Bank of America, those types of companies. Well, fast forward to where we're at here today, then we get more of the asset managers and broker dealers and other kinds of institutions from the financial perspective, including groups that delve into mergers and acquisitions activity and launching of IPOs and all that kind of stuff. So that's kind of where Morgan Stanley and Goldman Sachs hang out these days. And of course, both of them have been kind of tied to one another as the years have gone on. Of course, we all remember what happened back in 2008 when there used to be 5 big institutions, but 2 of them went by the wayside. The first one was Bear Stearns earlier in 2008, as it was basically absorbed by JP Morgan for a couple of bucks. And then, of course, later in the year was when Lehman Brothers just imploded. Anyway, Morgan Stanley and Goldman Sachs have been kind of joined at the hip for a long, long time at this point. But today they were certainly at odds with one another, as Morgan Stanley had one of the bigger days on the board with a bright green color, up 5.91%, whereas Goldman Sachs was exactly the opposite. It was down 6.44% today. Part of the reason, by the way, that the Dow Jones probably underperformed today, because of course Goldman Sachs and Travelers, which also reported today, which is down 4.6%, are both part of that Dow Jones Industrial Average. Remember, Morgan Stanley has started to change its stripes a little bit as the years have gone on. So they might not rely upon their proprietary trading desk as much as they used to in terms of the total percentage of earnings that they're making. Morgan Stanley, many of you are aware, bought E-Trade as just one example. And they've bought a lot of other companies in recent years as well. So they're starting to kind of diversify their business quite a bit more than the way that we used to think about them, whereas Goldman Sachs kind of still plays their traditional role. So that might have had an impact as to how investors thought about those two entities here today on opposite ends of the spectrum. In terms of other areas that were red, quite a bit of red all over the place. We did see Emerson, by the way. This is a dividend aristocrat company, one that we really haven't talked about a lot in my DGI classes in recent years because it's done pretty well in the last couple of years. But it is one that we have purchased multiple times over the 9 years that I've been teaching many of you guys the dividend growth investing style, both here at Market Scholars and, of course, previously over at TD Ameritrade. So Emerson used to be a stock that was out of favor with a high dividend yield, and we were happy to buy it when that was the case. But fast forward to where we've been recently, Emerson has been a popular company with a high stock price and a low dividend yield, and therefore we're not as interested in purchasing it here at these more elevated levels. Nonetheless, it has a great history of not only raising its dividends for the 25 years it requires to be on an aristocrat list, but they've actually raised their dividends for more than 50 years in a row. In other words, they're an official dividend king out there. Today, their crown was knocked off of their head, however, and the stock was down about 6.8% here today on news that they wanted to buy out another company. I think it was National Instruments, and perhaps go hostile with that acquisition or proposed acquisition. And therefore, the market doesn't necessarily like what they see, perhaps assuming that they're going to end up having to pay through the nose for the merchandise if they are set in their ways for desiring that other company. So we'll see how that shakes out, but that was a unique news story specifically with that company that caused that type of a give back today. Usually that type of company does not move 7% in a single day. We saw that Pfizer also had a pretty tough day. It was down about 3.7%. By the way, I did see that one of the companies that they are closely aligned with these days, Moderna, was up after hours. You don't see it here because this heat map is only showing us what happened during the normal market session, but after hours I noticed Moderna was up a whole bunch off of some positive drug news, and so perhaps that will be a shot of adrenaline for some of those healthcare stocks as we go into tomorrow's trading. We shall see. But for today, it did seem like healthcare was a bit out of favor with all of your big boys and girls all in the red here today. Johnson & Johnson, Merck, Lilly, Pfizer, Bristol Myers, United Healthcare, AbbVie, Amgen. They're all kind of sitting there in the red. So not a whole lot of traction in that particular area. And that was really the case across the market. I didn't really see a whole lot of bullish traction out there other than some of those aforementioned mega caps that just kind of happen to have good news here or there for a variety of reasons. But for the most part, it felt like today was a little bit of a slog in the market where we were just kind of revving our wheels in the mud, not really going anywhere, just kind of slip sliding a little bit. So not exactly what you want to see after having a couple of weeks of really strong rally. Then again, the fact that you didn't really have a massive sell-off, I suppose, is maybe calming to the nerves of some. It's just that we didn't continue the bullishness that we've been used to so far in 2023. You'll notice, by the way, Google was down about 1% today. Amazon was down about 2% today. Home Depot was down about 1%. Some of those telecom companies like Verizon, AT&T, and T-Mobile were down pretty significantly today as well, and I'll actually have a little bit more to share on that point as we get into our trade application example at the end of tonight's video, so stay tuned to that. Let's go ahead and see what the specific breadth numbers were here today. And as you can see, when I've got the S&P 500 pulled up in the Market Watch visualize area of the Thinkorswim platform, 191 companies ended up closing higher here today. So, that was good for about a 38% hit rate to the upside. And that seems to make sense in my mind as well. There seem to be quite a few more red squares and rectangles on the heat map than the green ones that we did see. So today seemed like it was a day that was somewhat dictated by the bears. It wasn't an overwhelming day by any means, but nonetheless, if you were to put the check mark in the scorecard for either the bears or the bulls winning today, I would say that it does seem like it was firmly in the bears camp here today from our breadth measures. Let's go ahead and now take a look at our foregrid on the main part of the platform. And so this is chart 4B for those of you that are premium market scholars. And by the way, be aware that we did have some updates to our various customized charts that we build for all of our premium members out there. Hopefully those of you that are premium members caught my note on that late last week on Telegram, but in case you didn't see that, I'll use this platform here in the hopes of getting that message out a little bit more as well. So I ended up updating one of my charts over the weekend as well. I think it was chart 1A, and then we updated a handful of David's charts as well. So seek that out, and most of you know where to find that on our website in order to upload your shared links into your own platform if you are a premium member of ours. Obviously, if you're not, then you wouldn't have access to that. But just a friendly reminder in case you need something else to put on your to-do list to get some of those new charts implemented into your own platform. And some of them, by the way, were just updates. A couple of them were brand new. Some of them were just updates of old charts as well. Anyway, this is chart 4B here, and what this allows us to do is to see all four of our major market indices at the same time. And so it allows us to kind of compare and contrast a little bit easier than just looking at one chart at a time. So that way we can try to look for differences and things like that. So let's kind of get started here with the most important index out there, or at least that's the assumption of most, which is the S&P 500. And that's the chart in the upper left here. You will see here that we were down 0.2% here as of today, and it was a rare down day so far in this calendar year for the S&P 500 specifically. I would also point out right here that the NASDAQ was up yet again today, not by much, but the reason I'm kind of emphasizing that here today is this was actually the 7th day in a row that the NASDAQ was up. So they're fighting back with a lot of grit here all of a sudden. Remember, last year the NASDAQ was the laggard more often than not, and it seemed like any time they wanted to kind of put a win streak together, it usually ended up with a whimper, not much pizzazz behind the move. But this has been a little bit more of a serious move they've attempted to make. Nonetheless, they are still well below where their highs were here in the middle of December. And so we've got a ways to go. We shall see. But the good news is that the sellers have not come in and overwhelmed the buyers like we saw so often last year with the NASDAQ. But again, back up to the S&P 500. Be aware this is our 2nd day in a row now of bullish or strongly bullish posture, I should say. Remember, we've actually had a bullish posture on this going back to January 5th, but when the background color is that lighter green like that, it just means that the posture is not quite as robust. That shows up, by the way, in case you were wondering, when the green line is rising out of the lower reversal zone but has not yet crossed the 50th percentile on the market forecast indicator. But once that green line goes above that 50th percentile and is still rising, then the background color turns that darker shade of green, kind of letting you know that it means business. It's not just a fluke, because remember, stocks can bounce and give you head fakes and do all kinds of things when it's not really going to lead to much. But the more consistent the move, the greater the chance is that there will actually be the green line rising back into the upper half of that indicator, and that usually is a pretty strong sign, all else being equal. So we continue to have a strongly bullish posture there for the 2nd straight day. We have a strongly bullish posture on the Dow Jones for the 3rd straight day, 3rd straight day for the Russell 2000 as well. And today was our day where we switch from weekly bullish posture to strongly bullish posture on the NASDAQ composite. So we can say with all 4 of these charts that we have a clean sweep of strongly bullish posture that is just added to what was previously weekly bullish posture for pretty much the week plus prior to that. So, again, another way to say that the activity so far in 2023 has been pretty promising. It's been constructive, right? There's been a lot of other, measures out there, breadth measures, that have kind of confirmed that as well. If you kind of go in and spend some time on FinTwit, as David and I oftentimes do, there's a lot of other statistics out there people are citing that suggest this has been a pretty reasonable rally here. It's not just a fluke. So there is a chance for the bulls to kind of get things together here. Of course, the challenge there is the fact that the Federal Reserve still doesn't seem to have its job done yet in terms of getting inflation under complete control. There's been signs of it, of course, and that's what we learned last week with the CPI and other numbers. But there's also signs of the opposite. A lot of the meme jokes on Twitter right now, M-E-M-E, if I'm saying that right. I don't know if you say it meme or mame or what, but a lot of the memes out there are revolving around eggs and how eggs are the new lumber. Remember a couple of years ago when lumber prices were exploding higher, and there were all the jokes on Twitter and social media about spotting millionaires out in the wild with people hauling lumber and stuff. Well, now the joke is you open up your refrigerator, and if it's full of eggs, then you're doing quite well for yourself. So anyway, eggs are a somewhat unique example because of some of the bird flu and stuff that's going on there. But nonetheless, it is just a reminder that there's still a lot of inflation out there. I was kind of price shopping for hotels on an upcoming trip I've got later this year, and I've noticed that hotel rates are still very high and very sticky. In other words, they don't seem to be coming down with some of the other areas of the economy. Then again, maybe that changes in the future, right? And that's the whole point of us doing these videos and tracking statistics as often as we do, because things do change. But I don't think we're to the point yet where the Fed is thinking to themselves, okay, our job's done here. We can just go back to lowering interest rates again. I still think that there's still a little bit of a battle in front of us. So that's what the markets are grappling with right now. There is legitimate evidence of bullishness out there, but my fear is that we still have plenty of legitimate challenges in front of us in terms of what the Fed is attempting to do and any liquidity that they may try to inject into the system or, more importantly, take out of the system. And so we'll keep our our ears to the ground on that, and if we hear anything of importance, we'll do our best to share them here in these videos, and of course in our daily classes. Remember, these videos we do for free on a volunteer basis, but our actual job, David and I, is to work with our premium members during our premium program where we teach 5 classes a week each. And so our hope is that many of you will become those premium members if you have not had an opportunity to do so yet. Anyway, Dow Jones was down 1.14% today. And as I mentioned earlier, that's not a huge surprise because remember, the Dow Jones is a 30 stock index, and today 2 of the worst stocks in the entire S&P 500 happen to also be Dow Jones 30 stocks, and those 2 companies are Goldman Sachs and Travelers, with the 3rd worst one in that group, Emerson. But Emerson is not a Dow Jones member, but the other 2 are. So you had a higher hit rate within just those 30 stocks with truly underperforming securities, because in the case of Goldman and Travelers having their earnings announcements here today and not being very well received by the market. So today was a rare day where the Dow Jones did lead to the downside, but that was mostly because of the uniqueness of the makeup and the composition of their index there. So I don't know if I'm going to read too much into that quite yet. Sometimes that can give you a little sprinkle of news or insight, but right now I'm just going to take it for what it was. It was a situation where 2 out of the 30 stocks happened to report bad earnings today, and therefore it's going to have an outsized impact on that index here today. So it was down over 1% today. And you can see that the Dow did not quite get that high that we saw right there on December 13th and take that out before rolling over here today. So that's another thing that you can kind of put on your list if you're kind of putting together a wish list for what you'd like to see happen with the market. If you want to be bullish moving forward, is you need to see some of those old highs getting taken out. So this is not a great sign that as we were approaching those old highs, then we have this little bit of a reversal here today. And the same thing can be said with the other indices as well. You'll notice that the Russell 2000 has been the most important, or the most impressive, I should say. And I shared that commentary with you guys exactly a week ago, last Tuesday, when I was with you as well, that I was, a little surprised by it because I really wasn't giving them much thought up until that moment. But a week ago would have been, I think, this day right here. Yeah, this was the 10th. Today is the 17th. So a week ago would have been this candle right here. And I was talking about how the Russell 2000 had 2 really impressive candles out of the last 3 days, and had given themselves a lot of separation above that 30-day moving average. Well, look at what has happened since then. Today was basically a nothing burger, but look at the 3 prior days here before today. This candle, and this candle all followed up this 2 out of 3 day impressive candle that I had mentioned a week ago. Of course, this was a week where we had a holiday, so that's why there's only 4 candles after when I was with you a week ago. Normally there would be 5, but 3 out of those 4 candles were awesome candles, right? Where we're basically closing pretty much at the high, or at least within a stone's throw of the high of those candles. So really, when you look back over, let's call it the last week and a half or so, you had this candle that I would say is incredibly impressive, this candle, this candle, this candle, and this candle. So we basically had 5 out of the last 7 days on the Russell 2000 that I would classify as very impressive candles. Not just like, hey, that's a pretty good day. I'm saying like a great day for this index. And to stack them all up next to one another, one after another, tells me that the small caps mean business here all of a sudden. And I have a feeling that when we go into my factor-based swing trading class again tomorrow morning, as was the case last week, we will probably see an impressive result out of the low size factor, which kind of teams up well with the Russell 2000 broad index that we see here. But the reason I started this conversation is because I wanted to compare it to what we were seeing up here with the Dow Jones. Notice that the Russell 2000 is very close to breaking out to its own highs. You could say that in the last week, the Russell 2000 has taken the baton from the Dow Jones Industrial Average and is now considered the leader of this market, or at least that's the way I would perceive it. And remember, a week ago when we were having this conversation as well, I was directing you to what the intermediate readings were on the various charts. And at that time, the Dow Jones still had a higher intermediate number than the other three indices. Notice today, that is not the case. Now you see that the Russell 2000 is almost in the upper reversal zone, just a hair below 80, whereas the Dow Jones is way down there at 67. Now it's still in second place, but that's a big difference, right? It's not just like a small little cross of those two. I mean, the Russell 2000 leapfrogged the Dow Jones here in just a week's worth of time because of these extremely impressive candles that it's been putting together almost on a daily basis. So there's a lot of juice there behind the Russell 2000. The other thing I would mention is notice that the Russell 2000 is the only one of these four indices that has a green 30-day moving average right now. Remember, that signifies price is above a rising moving average. With these other charts, notice we've got yellow, we've got yellow, we've got yellow. What is being displayed there is price is above a falling moving average in those three cases. But in the case of the Russell 2000, while it's hard to make out with a naked eye right here, the numbers don't lie. That moving average, the 30-day moving average, is going up slightly here day over day, and price is well above it. So that's yet another way. So there's two different ways for you to make the claim, at least with this chart's perspective, that the Russell 2000 is our new leader. They're the king of the hill. The first way is looking at the intermediate line, as I mentioned right there. And then the second way is looking at the color being different on the moving average than the other two. So that's why you can't fall asleep in this market. Things can happen in a hurry, and pretty much all of this outperformance happened within a week and a half on the Russell 2000. So it's been really interesting to watch. It was, by the way, down barely today. Call it flat. It was down 0.15%. So basically held those previous gains that it had basically every day last week. On the NASDAQ, it was up 0.14% today. That's probably because, remember, Apple was up, Microsoft was up, Nvidia was up, and Tesla was up. Those are some of the most important companies in the NASDAQ composite, being more growth-oriented, tech-oriented types of firms there. So they were our leader today, but on an intermediate basis, they still remain our laggard. Remember, today was a rare day where Tesla did very well. Usually it's been the exact opposite. And so right now the intermediate line on the NASDAQ is still at 55, which is the lowest of these four different charts that we're looking at right now. So credit where credit is due. Again, 7 days in a row is nothing to sneeze at. That's a pretty impressive feat. That does not happen very often. Nonetheless, because they were so out of favor prior to starting that 7-day win streak, they still remain somewhat of a laggard on more of an intermediate basis. So right now, NASDAQ still our laggard. Russell 2000 you can consider our new leader at this moment in time. But all four of these charts technically have their strongly bullish intermediate postures according to the market forecast technical indicator. So on the whole, 2023 has been impressive and a very constructive start to the year, regardless of what may be in store in front of us as we move forward. All right, let's go ahead and take a look at our 3 green arrows strategy here. I assume we'll probably have some 3 green arrows signals, but let's just verify it here. Yeah, and that is the case. I had a feeling that would be the case because a week ago when I was with you, that was the case for some of these as well. And that still is the case here today. All 4 of our charts do have that light shade background here on chart 4D, and what that signifies on this particular chart is that we have a 3 green arrows signal in effect. For those of you that are not familiar with that language, it's something that came from the prior company that David and I used to work for, Invest Tools, where the 3 green arrow trend trading strategy was pretty well known amongst our students. Anyway, we carried that philosophy forward here, with our analysis during these videos, since we used to do videos very similar to this when we were at our old company as well. And that way it allows us to kind of segue things a bit better for those of you that like that 3 green arrows approach. And basically what it is we're just looking at 3 different technical indicators and trying to determine whether they are considered bullish or bearish at any given moment in time. The 3 different technical indicators are the 30-day moving average, the MACD histogram, and the stochastics. And sometimes these can kind of get scrunched up. So sometimes you have to move these areas of your chart to see the arrows a little bit better if you need to. The other thing that you can do, remember, is right-click on one of these charts on the grids and then go to maximize sell, and then you'll be able to see that quite a bit better. So here's green arrow number 1 as the price advanced above the moving average. Here's green arrow number 2 down below on the MACD histogram, telling us that this particular index has momentum. And then down below here you have the third of the 3 green arrows with the stochastics, which is telling us that price is closing near the highs of recent trading ranges, which is also a bullish feature. So that's another good sign with this market, is that all 4 of our broad indices in the United States do currently have a 3 green arrows status. All right, let's go ahead and take a step away towards the to the internet here for just a moment. I always like to get a chance to say thank you to those of you that help support these free videos that you find here on YouTube. Many of you are aware that it takes David and I at least 3 hours worth of our time to do this free video. So we really have to question whether doing the video is worthwhile or not. And of course, we oftentimes will do so if we get the the impression that you guys want them and you're willing to support them. And so usually what we're looking for is 100 likes on Twitter. That's kind of an easy gauge for us to determine, are we making an impact with these free videos, or are we just wasting time? Of course, we don't want to waste our own time, let alone your time. And so we want to do our best to make sure we're giving you a good experience there. So if you appreciate the effort that goes into these videos, we simply ask that you click like for us there on Twitter. As long as we're up and over 100 likes, we're happy to do those longer form videos, or at least I am. What happened on Thursday, in case anybody was wondering, some of you saw my Telegram note and also was mentioning it on Twitter itself, but my internet went down on Thursday. That doesn't happen often. Every so often you might see it, maybe like twice a year is kind of what I'm thinking in that regard. But that was one of those days on Thursday, unfortunately. Comcast sent out some notes to all of us saying that, unfortunately, your service has been disrupted. Here's our ETA on when we expect to get it done. But of course, Comcast is rarely on target with their ETA. So I was hoping they would get it resolved in an ample amount of time, but that just simply was not the case. So I apologize for that. I had every intention in doing the video on Thursday. It's just that I could not do the video without access to the internet. So it is what it is. But I'm back in action here today, and I do thank all 116 of you that stepped up and clicked the old like button there for me on Twitter. Anytime we're up and over that, I'm happy to give you a full-length video like I am right now. On the other hand, if you prefer the short 15-minute videos instead, then don't click like. And if we're under 100 likes, then I'll just give you a quick little recap of the 4 major indices without any trade application or extra 12-grid chart analysis or anything like that. So it kind of allows you guys to have a little bit of an impact as far as, how I do the videos. And if you like the longer form videos, click like. If you don't like the longer form videos, don't click like. Pretty straightforward there. All right, while we're over here, let's also take a look at the sector selector. I like to bring folks over to the sector selector and other areas of our website on occasion, especially to introduce some of you who are not premium members of Market Scholars to our website. Otherwise, you might not know that we have a website. And, of course, most of what David and I do is dedicated to the premium side of our business, not this free YouTube video here that some of you are listening to right now. So one of the tools that we have available for our premium members, amongst the many, is our sector selector tool. And we put this together alongside the stock selector tool for my Monday morning top-down trend trading class. Now this week, we didn't have a class on Monday because it was Martin Luther King Jr. Day, but normally on Mondays we have that class. And so I do try to put these tools together, as long as I have the ability to do so. And I was able to do that. I didn't go anywhere this past weekend, so I was able to get those tools put together. So as you can see, this is as of January 13th. So it's a couple of days old. But this week, since there was a holiday yesterday, really it's just really one trading day old at this point. But it was kind of an interesting one because of what I'd mentioned on Twitter as well. Some of you have already seen me post this on Twitter. One of the advantages of following me there, you get this information information sooner than a lot of other people. But one of the things I commented on over the weekend when I posted this is that it's kind of interesting to see the consumers on two different bookends of the graphic here this week. Consumer discretionary is now all the way up there at number 1. And remember, that does not include anything that would have happened today. And I had already mentioned that Tesla had a big day in consumer discretionary today, so it might have even added to the relative outperformance. Keep in mind that this graphic here is on an equal weighted basis. Nonetheless, some people have been waiting for the market cap weighted consumer discretionary to start perking up, and maybe, just maybe, if Tesla can start, stop going down and start going up a little bit more often, then maybe even the market cap weighted version of it could do well. But even on an equal weighted basis, it's been doing pretty well for a while. Consumer discretionary, with this blue peg here, you can see has been in the upper half of the graphic more often than it's been in the lower half of the graphic over the last 3 months. So this is not something that is new, all of a sudden just showed up on our doorstep. This is something that I've been working with you guys on and talking about here for the better part of the last couple of months. And so this is not just some sort of a random fluke in the data. This is legitimate strength in many consumer discretionary charts out there. Prior to today, Tesla was hiding or masking the fact that many other consumer discretionary stock charts look very strong right now. On the flip side of that, consumer staples fell all the way to dead last. Now, many of you know, because I've mentioned it in my classes on Twitter and in these presentations plenty, that my personal biggest sector is consumer staples. And so I'm not necessarily thrilled when I see consumer staples fall out of favor as they have in recent weeks. Then again, as you've heard me say in this presentation in the past, I'm willing to, give out some sacrificial lambs here and there. In other words, I'm happy to give up my own happiness for the happiness of the market at large. And generally speaking, when the consumer staples are out of favor, like they are at this exact moment in time, that is a time when the market is more interested in taking risk, and there's a better chance that the overall conditions of the market are bullish, as opposed to the opposite. When consumer staples are leading, usually that's a defensive posturing mechanism where the whole market itself is not very bullish and not willing to take risk. So anyway, kind of interesting to see consumer staples fall out of favor as quickly as they have. Remember, just a couple of weeks ago, they were up here in the 4th position. Now they've fallen all the way to 11th, and it's been a long time since they've been dead last. I'd have to go back and check my records, but I'd have to believe it's been probably at least a year or more since the consumer staples were dead last year. So this is not a normal occurrence, what just happened here over the past week. Nonetheless, it's a way for us to kind of be flexible and, change alongside the markets. And right now the markets are saying, in not as many words, that they're willing to take risk, right? We just got done watching all of those, or looking at all of those foregrids here a moment ago, where we were talking about the constructive price activity and how some of those indices are getting close to their multi-month highs. And, this is another way to kind of read through the lines a little bit to say, yeah, the market is willing to take risk right now. You have more kind of cyclical types of sectors up at the top, and you have more of your defensive types of sectors at the bottom, right? Utilities, REITs, staples are all dead last right now, and healthcare has kind of, tripped a little bit here recently. So what we've seen in the last couple of weeks, not only from a charting perspective, looking at the S&P 500 by itself, but actually kind of, peeling back the onion and looking at the sectors and how they are reacting and acting within the market, that's also a positive sign that there is more risk appetite out there right now than there had been more recently. Speaking of which, let's go ahead and now segue back on over to the Thinkorswim platform. And I wanted to pull up our 12 grid analysis starting with chart 5A and talk about Bitcoin here briefly. Remember, a week ago, I was talking about Bitcoin in this very video, and that would have been again on the 10th, right? Today is the 17th, so 1 week ago would have been the 10th, so it would have been this candle right here. And I was talking about how Bitcoin was starting to look a little bit more impressive all of a sudden. Now, I had no idea what would happen in the coming week after this, and I would not have predicted it would have done as well as it actually has. Nonetheless, there were signs a week ago that Bitcoin was on the cusp of making a reasonably bullish move. Now, this has been turning into what's effectively a parabolic move higher. But even a week ago, we were talking about how it had gone to a strongly bullish posture and how it had bounced up and off of its rising moving average, and how it had been a couple of months when we had been able to make that claim. And so there was actually constructive types of chart behavior on Bitcoin a week ago, even before this massive breakout that has taken place here. In fact, I had to laugh because many of you know that David was on Fox Business on Thursday. We're very proud of him. I'm very excited for his opportunity there because he does such a great job. And I'm glad to see a national audience acknowledging that and recognizing that. So he was on the Charles Payne show on Fox Business on, I think it was Thursday. And so I had to get a little chuckle out of it because, of course, David did a great job. But I had to laugh a little bit when one of the topics that Charles Payne wanted to discuss with David was Bitcoin, because, it's not like Bitcoin is, closely aligned and associated with David. He's willing to talk about it just like he's willing to talk about any chart, but it's not like he's a quote unquote Bitcoiner, right? So I had to chuckle a little bit when I saw that, but he was saying the same thing that I was telling you guys on Tuesday. He was saying the same thing on Thursday. Bitcoin looked a lot better. It was shaping up for a breakout. And that's exactly what we've been seeing. And remember, that's been carrying through over the weekend as well. Remember, Bitcoin's a little bit different than many of these other financial instruments because it was trading yesterday on Martin Luther King Jr. Day. It was trading over the weekend. Remember, Bitcoin and cryptocurrencies trade on the weekends, unlike the stock market. So you kind of get a little bit more insight out of them on the weekend as well. And so I was rather impressed with that. And remember, you can also pull up, I think it's BTC is another way to look at it on the Thinkorswim platform. Actually, it might be /BTC. There we go. As opposed to looking at the index that we were looking at just a moment ago, this is the futures contract for Bitcoin, which might be a little bit more liquid. And you can kind of see why it's looking quite exciting here all of a sudden. Look at how many days in a row Bitcoin had been up, at least on the futures market. And let me right click on this and go into maximize sell. So this would have been the day right here that I was with you a week ago on the 10th. And we were talking about how it had already made an impressive move and it had basically been dragging the 30-day moving average up with it. And I said I was Bitcoin agnostic, right? I'm trying to be flexible-minded around it. There are some people that love Bitcoin, and if you say anything negative about it, the Bitcoin army comes out and crucifies you. There are other people that are the exact opposite, that say, Bitcoin shouldn't be touched with a 10-foot pole, and you shouldn't trade it, and this, that, and the other thing, because it's all a bunch of garbage, right? And then there's all the rest of us that are basically willing to consider it if the setup is right. And, I was talking last week how the setup was starting to look a little bit more right all of a sudden. And as I look back now over the past week since then, it has basically broken out, right? Some of you might have caught it as it went above this prior resistance rate over here. A week ago, we weren't quite to that point, but it only took another day or two after that where we broke out above that resistance area. And then over here on the candle today, this has already switched over to tomorrow's candle here on that red candle, but this is technically today's candle in the futures market. Today, we did close at a new high from a 3-month basis according to the futures market on Bitcoin. You'll notice that the high was 21,725 here on this candle today, basically. And that surpasses, if you kind of use my crosshairs, that thin gray line going back to that candle back there at the beginning of November. And I'm pretty sure the closing price was higher today as well. So today's close was 21,435, and back here the close was 21,235. So yes, today's close on the futures market was about $200 higher than the close on this candle back here right before that rug got pulled. And that was probably right around the time that whole Sam Bankman-Fried thing was getting exposed. And so it's been interesting to see this entire move round trip now throughout that very controversial period right there. So all of a sudden, Bitcoin is yet another feather in the hat of the bulls that are out there that are looking for reasons to like this market right now. Remember, Bitcoin is effectively a way to look at risk appetite. And when Bitcoin is roaring, like we've seen in the last week, that means risk appetite is coming back pretty strong here as well. Who knows how it ends? Maybe it ends in tears. But right now, factually speaking, risk is back. At least it has been for the last week or so, according to what we see on the NASDAQ composite. And now looking at what we see here on the Bitcoin chart itself, in addition to what we just talked about a moment ago, looking at sector analysis and rotation, and that's setting up the way that you'd want to see a risk-taking environment as well. So, a lot more green shoots here all of a sudden compared to what we were looking at back in December. Let's take a look at a few other charts here while we're over on this 12 grid. And let's take a look at what's going on with the 10-year Treasury yield, which you will see is in the lower right-hand corner here. Today, the Treasury yield went up just a skosh, but closed at about 3.53%. Remember, for the longest time when 4% was kind of the area that, a lot of people had their eyes on as a big round number. Feels to me like that temperature has changed quite a bit here in the last month or so. And now the big round number that the Treasury market is dealing with is closer to 3.5%. So that has allowed the market to be a little bit more bullish there as well. Remember, if the market thinks that the interest rate environment is going to keep going up day after day after day into infinity and beyond, then the stock market is going to have a really hard time getting any sort of attraction in that environment for a variety of reasons, including discounted cash flows and the heavier borrowing costs that many of the, especially U.S. institutions will have, because we have a lot of indebted companies in this country. And if their borrowing expenses are going to go up in the future, that's going to cut into corporate profits, which cuts into the ability to pay higher dividends and all the other things that investors traditionally want. So the stock market doesn't like it when the interest rate environment goes up and up and up and away. And for parts of 2022, it kind of felt that way out there, which is when the stock market was at its squirreliest moments. Right now, the market hasn't been too squirrely. It's been pretty stable. And part of the reason behind that, from my perspective, is we don't see an ever-increasing interest rate environment. You could probably classify the last month or so on the 10-year Treasury yield as being more flat than anything else, right? It's been basically chopping sideways. And the market will take that and say, you know what, we can work with that. What we can't work with is ever rising interest rates, but we can work with choppy sideways interest rates a little bit better. So, we've seen a little bit more robust and bullish trade activity as a result of that. Now, keep in mind, on days when the Treasury yield is up, usually you find government bonds themselves down, and that is what we saw today with TLT. It was down about 0.65%. Now keep in mind, this has been a pretty healthy chart, so TLT still resides above a rising 30-day moving average here, so I don't think all hope is lost yet from that perspective, despite 2 straight down days. We kind of earned the ability to have a few down days here and there because of the bullishness that led up to those down days. But we'll want to keep our eye on that. Obviously, if there's a chance that the 10-year Treasury can get up and over its falling 30-day moving average, then there's a pretty decent chance that TLT can go down and below its rising 30-day moving average. So we'll keep our eyes on that. Right now, it's pretty steady as she goes, but you never know when the Federal Reserve says the wrong thing, or there's a bad CPI announcement or something like that that can change kind of the way that the market is interpreting those things. Right now, it's calm, and we're happy with that. Stock market can do well when things are calm in the Treasury market. You can see down below, the US dollar is still sputtering lower. It just seemed to not get out of its own way. We've really been in a falling dollar environment now for, you can call it an official 3 months at this point, right? We might not have recognized it until about right here in the first week of November or so, because we wanted to give it a benefit of the doubt on this bounce over here like it had done on 2 or 3 other occasions earlier in 2022. But once that bounce failed, it looked pretty apparent that the dollar was about ready to give back much of its gains that it had previously, and that is what we've seen here. This has been basically a strongly bearish US dollar environment for much of the last 2.5 months, and we've been below a falling moving average with basically that entire run, except for that one day right there where we managed to close above the moving average for one day, and then the very next day back below it again. So it's been persistently bearish for the US dollar. And remember, when that happens, you will find more times than not that foreign stocks can outperform. And my oh my, does that define what we're dealing with right now? Notice EFA up here at the top. That's been an impressive move there as well, with many days in a row to the upside, including tacking on 0.31% today. That tracks stocks in Europe, Australia, Japan, and elsewhere in the developed world. In the developing world, or the emerging world, like China, India, Mexico, etc., that's where EEM can give us that gauge, and EEM looks great as well. Now, it was down a touch today. Nonetheless, it has been just erupting higher. Look at these returns, by the way. Over the last 3 months, EEM is up about 17%. That's what that red number right there is recognizing. And then over here, the black number for EFA says 23%. So they're both positive numbers. Remember, if it was negative, it would look like this number down below here with the 10-year Treasury, where it would actually show a negative sign in front of it. Sometimes people might confuse that and say, well, that red, does that mean that's actually down 16% over that time? What that red recognizes is that today was a red day, but the total return over the last 3 months for EEM is 17% to the upside, 23% to the upside for EFA. Those are outstanding numbers for a 3-year or a 3-month time period. Remember, the stock market generally gives you about 8 to 10% annualized returns. And so when we're talking about 17 to 23% returns in 3 months' time, it's kind of out earning its potential right now. Now, part of that is because it had to, right? After last year, it under earned its potential. So it's kind of trying to balance the scales here a little bit. But those have been really nice moves. And we've actually been trading some foreign stocks in some of my classes out there because we're recognizing that the trends are starting to perk up outside of the United States at a greater rate than inside of the United States. It's not that it's been too difficult to find good trends here in the US either, but the hit rate's been almost more impressive outside of the US. And remember, that has not been the case all that often over the last decade. The US has been a leading area from a financial markets perspective more times than not. So right now is one of those times where foreign markets are leading in front of the US markets. Remember, when the US dollar is weak, it's also an environment where gold can do pretty well. And this is something that we spotted early on, even earlier than some of the other trends that I've talked about. Here we saw this violent move back here in November on gold. And, I said many times at that time that it is my impression that gold is making a legitimate trend-changing type of a move right now, and all else being equal, I expect it to go from being in a downtrend to now being in an uptrend. And that has continued to be the case, and I have not, wavered in my mindset around that. If anything, I've been emboldened by the way that it has acted. It's acted great for the last 2.5 months here. Now, obviously, things don't grow to the sky forever without any pullbacks, so there will be pullbacks that happen along the way, but what I'm hoping for here out of gold is that we have pullbacks kind of like we saw over here, where we give some of the move back, but not all of it, and we stay above the rising moving average. So far, so good. That has been the case for gold, and it's been the case for many of the gold mining stocks like Newmont and others out there as well. So been really impressed with gold. Today it was down just a touch, down by 0.65% when the dollar was up today. Nonetheless, this remains a very resilient chart right now, one that is firmly in the bullish category out there, one of the better looking trends amongst especially asset classes out there. By the way, preferred stocks broke out today as well. So we talked about the breakout in Bitcoin. Preferred stocks don't get the press that Bitcoin does. Nonetheless, over the last 3 days, we've gotten well up and over this prior high from December 2nd on preferred stocks. I'm using PFF as my proxy for that here. So, and this has been another area, by the way. Look at how many days in a row of upside action we've had in the preferred stock ETF. 1, 2, so those were the last 2 days of last year. 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. This is its 12th day in a row of upside after getting this oversold cluster signal here with this little green dot. I would have to imagine that hardly ever happens throughout history. Might be fun to go back and check on that, but I'm going to guess that the preferred stock market does not go up or down 12 days in a row very often. Maybe just a handful of times throughout history. We're seeing one of those right now, and this has been another area of breakout as we've seen Treasury yields starting to slip here a little bit more. Let's take a look here at our sectors. We'll take a look at chart 5C for that conversation. And here you can see that we have a couple of pink charts, but they're on the bottom rung. Remember, on my charts, the bottom rung is the defensive sector. So when they're underperforming, we're generally saying that's okay, right? We want the cyclical areas doing better than the defensive areas, and that is the case right now. So consumer staples has the strongly bearish posture. Utilities has the weakly bearish posture as the only two pink charts on the board. Utilities were down 0.14% today. Staples were actually up just a hair, up 0.07% today. But the stronger charts are the ones that are above, right? Something like communications comes to mind, up there near its multi-month highs. Financials are up there near their multi-month highs. Industrials are up there near their multi-month highs. Materials are up there near their multi-month highs. And even real estate is up there near its multi-month highs, which kind of came out of nowhere. Last Tuesday, 1 week ago, we actually looked at the real estate investment trust for my dividend growth investing class on Tuesday morning. Little did I know that the REITs were going to explode higher the day immediately after that. But that's been really impressive. And by the way, I taught my DGI class again earlier today. Today we concentrated our efforts on the financial sector. So if you're looking for additional educational content, that recording has been posted to our class calendar. Feel free to check that out if you so desire. But that one has been rather impressive out of nowhere as well. So there's a lot of charts here trading pretty firmly, even charts above their rising moving averages like communications and materials, and even the REITs can make that claim right now. So on the whole, you look at all 12 of these charts, that includes the S&P 500 in the upper left, and you'd say, things look pretty healthy, right? This is what you want to see. The areas that have some weakness are the areas that are somewhat, they lack in importance, I guess would be one way of saying that, with the staples and the utilities being a couple of the smaller sectors out there from a components perspective. And because both of them are defensive, you can think of them as the sacrificial lambs. Throw them out there. Give the bears something to work with, but meanwhile, have the bulls actually making advances where it counts in those bigger sectors that are out there and more important. All right, let's go ahead and talk about our trade application example now. And for that, I will bring up just chart 3A, which is our swing trading one grid. And I'm going to bring up T-Mobile, ticker symbol TMUS. So remember, this trade's already been done. For those of you that are premium members, we always tweet out about it, or not tweet out, but telegram out our trade details, and giving you guys an informational edge over anybody else who's just watching the video for free on YouTube who's not part of our premium subscription. So the trade's already done, and what I did was I sold a bear call spread on T-Mobile using the February contracts. And I believe my strikes were 155 as the sold call strike and then 160 as the bought call strike. So combining those two things together creates what's known as a credit spread. In other words, I received a credit up front for selling that spread, and it's also known as a bearish credit spread. So in other words, we want the stock to do poorly, not do well. In this case, I've drawn this blue line up here to give you a sense of how much flexibility I have with this trade. This blue line represents our break even in this particular trade. And I think I got $1.16 for selling that $5 wide spread, which is right around your 30% return on risk that we usually shoot for with these credit spreads. So if you add $1.16 to the sold strike of 155, that's where this 156.16 comes from in terms of our break even on this trade. And what I want out of this trade is for this stock to stay below the blue line. So the stock could either go sideways, the stock could go down, heck, the stock could even go up. But as long as it doesn't go up by more than $10 per share, I could still end up making money on this trade. So it is one where your rewards are not significant, but you have higher probabilities of success on your side to kind of make up for that. Here's the downside of it. They do have earnings coming up here shortly. Remember, most companies are going to have earnings coming out here within the next, let's call it 3 or 4 weeks. And so chart after chart that I was going through, unfortunately, did show earnings on the horizon. So it wasn't something I had a great ability to avoid in tonight's trade application example. However, keep in mind that when we're doing a sold spread like this, a bear call spread, we have defined risk. So if the stock comes out, reports earnings, and the stock market just falls in love with that earnings report and it just shoots higher, kind of like we saw with Morgan Stanley today as opposed to the opposite with Goldman Sachs, and let's say that the stock just erupts higher and goes up to $175 per share. That's something I don't want, right? I want this stock to be bearish. But because we have a bought strike within that spread, a bought call at 160, basically means that anything above 160 is protected by the structure of the trade. I will still lose money in the trade. I just won't continually lose more and more money the higher it goes. So that is kind of the nice thing about dealing with spreads around earnings announcements. Yeah, you might get them right sometimes, you might get them wrong sometimes, but when you're wrong, you do know what your worst case scenario is before you place the trade. Whereas if you instead tried to short sell this stock and it had a great earnings announcement, you don't know what your risk is. It's unlimited to the upside. But with a bear call spread, you do have defined risk. You know what your worst case scenario is. The reason I like this stock here today as a bear call setup is it did have what's known as a bearish divergence signal, where you have a peak in the near-term line right here on January 6th. You had a follow-up peak here on January 13th that was lower, so lower highs on the blue line down below, and the two candles associated with those two levels are this one right here and this one right here. So in other words, price went up at a time when there was some reduction or bearishness going into the underlying indicator. You'll also notice that the green intermediate line is now falling as well. So you've got that pink background color telling us that we've got a bearish near-term posture, but from an intermediate perspective, the green line would be telling us the same information. And you also see that you've kind of got a lower high from these two prior peaks. So maybe you could call that a triple top, maybe slightly lower highs. Either way, it's more of a bearish element as opposed to the opposite, where you might see breakouts to the upside. And who knows, maybe that occurs in coming weeks. But for right now, I kind of like the bearish activity out of this chart the last couple of days. Despite its outperformance over the last 3 months, it's starting to give back some of those gains here at a level where you would have expected some resistance. So I kind of like where the break even is for this trade here. The downside, as I mentioned before, I will have to hold that through the earnings announcement, which will be early February. So that's what I had for you here tonight. I hope you enjoyed the presentation. Again, if you appreciate these longer form videos, if you want us to continue to do these free videos and provide these trade application examples, we ask one request out of you, and it only takes 5 seconds out of your day. Just click like for us there on Twitter. Remember, you can do that directly on our website with the little Twitter widget below the video that you're watching on the Market Scholars website. You can do it by just simply going over to Twitter and looking at the top of my timeline where it will be pinned. You can also look in the description area of the YouTube video itself for the tweeting question, for those of you that watch this video directly on YouTube. And then last but not least, for those of you that get our emails on our distribution list, there will be a little Twitter icon at the bottom of those emails that you can click on to take you to the appropriate tweeting question as well. So if you want to help us along and support these videos, that's your best way to go about doing that. Regardless, whether you choose to do that or not, I appreciate you checking out this video tonight. I'll look forward to working with you here, hopefully in a couple of days as well. So until next time, best of success with your trades and your investments. Goodbye for now.